I think you got to look at this as an opportunity to take some profit. You know, we have made a lot of money over the last 10 years, but even year to date, if you think about the money that we've made in the equity markets just over the last, call it now 6 months of the year, this is an opportunity to go from overweight equities to neutral weight. And the reason why, if you think about it, we haven't made money since September of last year. If you look at earnings right now, they're just not supportive enough to drive the markets higher. And then all the obvious headwinds from whether it's the trade issue or the Middle East conflict, these are reasons to go to neutral or even slightly underweight equities.
Okay, if you are offloading some of your assets and selling some of your equity holdings, what should you be selling in your view? I mean, is it a certain area of the market? Is it tech plays? Is it elsewhere? Or is it pretty much across the board?
I think you want to look at your less efficient asset classes. So I would start with small caps in the United States and to a degree emerging markets and especially international development. I have grave concerns about Europe. We made some money in Europe this year, but over the long term with the new head of the ECB coming in, still somewhat unknown, what they're going to do from really deflationary situation, I would exit Europe first, and I would look for less efficient asset classes like small caps and to a degree, emerging markets, picking your spots.
Okay, so Phil, this is Martin here. You're in idle. You're sort of just trundling along. Is the Fed likely to change your mind tonight if they hint strongly at a cut ahead in July?
So believe it or not, I'm on the other side of this. Not only do I think the Fed does not cut in July, I'm in the camp they're not even done for the year. And here's why. Remember the Fed's mandate, one, full employment and the management of inflation. Now, you could argue that there's some deflation in the United States, so he's kind of knocking at the door. But if you really get into the numbers and you look at the recent PCE numbers, you look at pure headline and core CPI, they're really not that bad. And if we see wages begin to strengthen further from here, let's say the labor market, albeit the last number wasn't great, but let's just say we get a tightening of the wage market, I think the Fed's on hold, if not potentially even go one higher into the fall, if we see wages creep back up to the 3.5% floor line.
If you're right, when are markets going to price in that literally disappointment? Because right now we're at about 88% or so for a cut in July. People are talking about 2, 3, possibly on the outside 4 cuts.
I just can't see 4. It doesn't make any sense to me. And the economy's not that bad. I mean, think about what you're asking for here. You want to cut in Fed funds rate while the S&P's near all-time highs. That's not how it works. So to your point, though, to answer your question, I think it begins in July when the markets don't see a clear path to cutting on this statement coming out in the next few days, and then follow on in July. If I'm right, then you're going to see real volatility going through the summer because of it, because of this anticipation of a rate cut, which I think is, as of right now, unjustified.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.